day. Welcome to another episode of Analyst Insights, your plug for everything economics, investments, and finance. I'm your host, Rufaro, and joining me is my colleague, Ranga. So this week, we saw the inflation numbers being announced. Inflation is down, both month on month and annually. So it's trending in the right direction. What do you make of these numbers?
Thanks for having me, Rufaro. So it's good to see these numbers below 100% for the first time. Bearing in mind that we're actually coming from much higher figures in the last 2 years or so, maybe around 800%. So it just shows you maybe that there's some progress that's going on. Obviously, there is still a lot of work or some bit of confusion because these numbers are also coming at a time where some other statistic is showing that the poverty datum line, the basket has actually gone up. So it still tells you that there's still some inflation that is going on. It's a good trend, it's a good progress, but it's not where we want because annual inflation above 50 is still quite a big number, bearing in mind that maybe if you are to invest in fixed income instruments right now, your rates at best you're getting 19%. So it still means that the investments that they are offering you returns that are much lower than your inflation. But also maybe the other way of looking at it is to try and understand the currency that's being used to calculate the inflation. Because generally you would say the US dollar inflation has been stable. US dollar prices have been stable for quite some time. But the Zim dollar prices have been, there has been some inflation on the Zim dollar prices. And part of that is coming whenever there is some adjustment in the rate on the parallel market rate. We know that most of us are earning our income in Zim dollars. So even if the US dollar prices are still stable, as long as you still have to convert from Zim dollars to US dollar for you to be able to be buying whatever you want, it still means there's an element of inflation, because if your rate last month was 120 and maybe this week it's 140, that's the extent of the price movement that is there. But it's good. We certainly hope that the trend will continue to a point where we are in lower double digits to almost single digit by the time we get to next year. And then what it means for the market. So I think what we've tended to see is whenever the inflation outlook is seen to be deteriorating, we were seeing some movement on the market, a lot of buying as people are trying to preserve value to hedge their position. So I think once inflation is gone down to say single digit level at some point, I think the value preservation motives or objective will fall away, and we'll start looking at the markets for what they are, the ability to create value, generate earnings, profitability, and good cash flows going forward. So that's some progress in a way. I don't know how you're seeing them.
Look, I think our market is I like to describe it as the equities market, the ZSE. I like to think of it as it's the investment environment. It's a negative alpha environment. So you're not looking to make a positive real return. Basically, I think every investment manager's conundrum is deciding what is the least bad option. Because if you're starting from a Zim dollar position, even if you look at this lower inflation number at 56%, what you're saying is that in real terms, in a year, you've lost 56% of your value. So definitely, if you are running an investment fund or portfolio, it doesn't make sense to hold Zim dollars, because that will, simply by function of inflation, be your worst performing asset. So you have to you can't hold cash. You have to find a non-monetary asset to ring fence your money from inflation. And even if you don't like the valuations or the pricing of these non-monetary assets, you're going to lose less value holding these non-monetary assets instead of holding on to Zim dollars. So that brings an interesting question. You touched a little bit on what's happened on the parallel market in the last 30, 40 days. So how believable are these inflation numbers in your mind in the context of the last 30 to 60 days in which we've seen the Zim dollar devalue on the parallel market?
Yeah, so I think if you're just looking at the US dollar numbers, like I've just said, there's been some stability. But certainly with the depreciation or the devaluation of the local currency, the Zimbabwean dollar prices obviously have had some, should show some big inflation movement. So if that was not captured in the last month, surely it has to be showing in the next month. And we've seen a number of enablers, if I could put it that way, have actually seen some prices going up. Things like utilities, so for your ZESA, and also data. We have seen most ISP providers increasing the cost of data, and we know that most people are working from home, so the cost of data has become quite significant for most businesses. And also, whenever the rate is moving, there are some adjustments, because say for maybe a few leading retailers, most of the businesses, they've got prices that are pegged in US dollar terms, and every now and then, if not on a regular basis, they are adjusting their Zim dollar value based on the exchange rate on the market. So now with the rate around 140, 145, last month we were talking 130, certainly just tells you that those prices will have to be adjusted. So I think the numbers are believable if you're just looking at them from the US dollars point of view, but the inflation is still there. That's why you find that the basket that I've referred to for the poverty datum line and so on is showing that a family of 6 is actually needing much more than they needed last month. That's a reflection of the inflation which is there. And if you just do a sample and ask what people are experiencing on a day-to-day basis, they are seeing prices in Zim dollars actually going up, and certainly not going down. But maybe this one is telling us that it's increasing at a decreasing rate, so which is maybe will be a positive thing.
That brings up what's happening on the auction. There was an interesting article written this week by a member of the Monetary Policy Committee, speaking to a backlog on the auction of about $200 million. What does that tell us about how the auction is working, or rather not working? And what is does that influence your thinking about the outlook of the rate on the auction market? It's been quite flat at 85 for several months now. Do you think that this backlog might persuade the bureaucrats setting the rate to be a bit more flexible and perhaps address the supply constraint?
Yeah, so I mean the article that you're referring to was talking big numbers, $200 million US dollars by way of backlog, and almost some 18 billion Zim dollars. I think what's happening is the central bank is actually using the auction rate to manage liquidity in a way. So this is the 18 billion that's taken away from the corporates, from these entities that are applying to get foreign currency on the auction, but then it's taking them a bit longer for them to be allocated the real US dollars. So you've got a scenario where the business is actually hamstrung in terms of cash flow, so that you don't have your Zim dollar cash flow because it's been set aside for you to get some foreign currency, and yet it's taking so a bit of time for you to get the allocated foreign currency. So it's one area maybe that's not being spoken about, that maybe the auction is actually being used as a way of also trying to manage the liquidity. And for a long time, there has been this talk about the backlog and how far behind we were in terms of getting people actually getting the allocations. Sometimes you hear we were about 6 weeks behind. Sometimes it improves to 2 weeks, 3 weeks. But it just tells you that the auction market is struggling to cope. For one of the reasons is the fact that the rate has been kept at around 85 for a long time, and yet on the power market we keep seeing the rate actually moving, and the gap is actually getting bigger. So it's actually becoming very unattractive, certainly to the sellers, the holders of foreign currency who have to sell at a much steep discount to what is on the market. And it just, I think also from some of the results that we've reviewed on this program, it's quite clear that most corporates are actually struggling with the idea of the auction rate being maybe the sort of rate that they can use for their operations, because some of their suppliers are supplying at implied exchange rates that are much higher than the auction rate, and the others are even demanding payment in actual US dollar. And you also have to acknowledge the reality that most of the transaction that's taking place is in actual cash, and the actual US dollar cash, you don't get it on the on the auction rate. So these are transactions that are happening outside the market. So that's why I don't buy this idea that 95% of transactions in foreign currency are happening on the auction rate. I think outside the auction rate, there's quite a huge big activity that is taking place. So it makes certainly the future of the auction would depend on how if there's going to be any adjustment to the rate, and also the extent to which this gap is going to be closed. You can't have this number increasing, even if it's not 200 million, even if it was just 100 million, it's still quite substantial.
So you make an interesting point about the disconnect between the parallel market and the auction rate. Mm-hmm. And I think for the supply side of the auction is basically exporters who have to surrender money in terms of our exchange control regulations. Now, I think that your typical exporter, obviously the revenue is denominated in hard currency, but I suspect that the expense side of the income statement is mostly in Zim dollars, but it's indexed to inflation mm-hmm. and or the parallel market. So as the gap widens, their expenses are going to basically increase while their revenue is stuck, at 85 for the official. Mm. What do you think the breaking point is for exporters, where it's not going to make sense for them to keep running their operations, because at some point the cost side of their income statement mm-hmm. is going to run away, and they're going to be facing significant negative cash flows. So right now the auction is at more than 50% discount to the parallel market rate. But what kind of, where do you think, how big can this disconnect grow to before it breaks the operations of exporters?
Yeah, so I think we are almost there now. That's why you're having this huge backlog. It just tells you that the exporters, beyond what they are expected or forced to provide to the auction, they are not excited about it. And I want to believe that if given an option, they would love to be selling their currency to buyers that can be providing a rate that's way above 85. So I think this gap just tells you that the supply side is actually seeing the price as not being close to where the market is, and it's very true. It's 85 versus 140. It's almost 50% now, and it's making the businesses unviable in a way. And I think it's going to take a lot of. In fact, there's need for quick intervention, either by way of just letting the rate move. I think that could be the best way, and otherwise would have a scenario where businesses will be forced to look for ways to preserve value, to defend value in a way that may actually reduce the foreign currency receipts that are recorded in the country, because there's no point in you generating this currency and you are being allocated Zim dollars at a very low rate. So I think the businesses are already feeling the pinch, and it's important that this rate is allowed to move. But you see, judging from the tone that you are getting from the authorities, they are saying the auction rate has got a bigger impact on overall inflation. So they'll try and manage it below a certain level so that they give a veneer of stability in the auction rate and the inflation rate, which then takes us back to your question about how believable are these numbers. The numbers it's very clear that numbers are being with the way the auction rate is being managed, it just tells you that even the inflation is actually being managed using the auction rate, and it's not sustainable.
Thank you so much for that, Ranga. That's all we have time for today. Thank you so much for joining us. Please like us on Facebook and follow us on Twitter. And as always, we welcome your comments and feedback. Cheers.